Strömberg, thanks for joining us.
Thank you. Thanks.
You have just announced the winners of the prize in economic sciences. Tell us, who won?
So this year we wanted to award research on financial market prices, and there are three laureates who share the prize. There's Eugene Fama from the University of Chicago, Lars Hansen also from the University of Chicago, and Robert Shiller from Yale University.
So what have they accomplished?
So their research has a lot been about, how well do financial markets actually work. Financial markets are really important for the economy because they decide a lot on what people invest in, how people save. So we really want to understand whether these markets work well and when they work well, or if we should do something about it. So that's basically what their research has been focused on. Now it's been what we call empirical, which means that all these three researchers are about looking at data and try to see patterns in financial prices. And a lot of what they've been working on is to look at whether you can predict how financial market prices behave in the future based on information we have today. Now this may sound a little bit mundane, but it turns out that this is a very important test of how well markets work. If markets actually work well and prices are correct, then we wouldn't expect to be able to foresee how prices are going to move in the future. And Eugene Fama, who started this line of research, he looked at whether you could predict basically by looking at the stock prices, yesterday or a couple of days ago, whether that had any information about how prices would move tomorrow. And he actually found that there wasn't much such predictability, which actually would imply that financial markets work pretty well in setting prices.
But it's possible to predict the future in the longer run.
Exactly. So this is where Robert Shiller, our second laureate, came in. So he started looking at horizons of maybe years or decades and actually found that you could predict how the stock market was going to do over those types of horizons based on information today. And in particular, what he found was that if you look at how expensive stocks are relative to fundamental values like the dividends, when stocks seemed expensive, you actually saw lower returns over the next 3 to 7 year period compared to periods when stocks seemed cheap, where you saw higher returns.
Does this mean that you should buy high dividend stocks?
Well, so this is not necessarily, okay? So, and this is where also Lars Hansen came in, because if you see that periods where the stock market seems to have a low valuation and returns are higher, it need not be that it's a good deal to buy stocks. It could actually just be that people perceive the stock market as more risky, and investors don't like risk, so they don't want to buy stocks, say in recessions, for example. And to induce them to actually buy stocks, they need to be compensated for this, and you would then see this higher return, but it would be compensation for the risk that they're taking. So that's sort of one explanation of this, and Lars Hansen has been very important in trying to test these types of models. It turned out that the simplest models we had for this did not really work, and Lars Hansen showed that with their methodologies. So now we've sort of trying to understand these patterns, trying to understand where we can build better models of how people perceive risk, and also try to understand to what extent this predictability is actually because markets don't work well, that markets overreact or underreact to information.
But we've learned that the market is always right. It's a perfect market. But then again, it seems like there might not...
So I think this is where the results are very different depending on what horizon you look at. So what Fama showed was if you look at over short horizons, days or weeks, we have no evidence or hardly any evidence that the market wouldn't be right. Okay, so the statement that the market is right may be true if you have a very short horizon. Now, when we start looking at these longer horizons, then it's not so clear anymore. But we always have to think about, okay, is it because stocks are risky, or is there actually some mispricing in markets?
So the markets are right in the short run, but less so in the long run?
At least that seems to be what the data suggests. We can't detect, it's very hard to detect deviations from efficiency in the very short run, at least deviations that you can really profit from, okay, because there are transaction costs in financial markets. While in the longer runs, we actually see this predictability that seems to drive differences in returns over time.
Will their research have any practical implications?
It already has had considerable practical implications. So one example of this is that when Eugene Fama and his co-authors came up with these results that showed how hard it is to predict prices in the short run, that was kind of important for practice, because a lot of practitioners actually spend lots of time trying to pick the right stocks and beat the markets over the next week or month. And this research indicated that that may be actually impossible. So as a response to that, there was a new financial product created called index funds, which basically just don't try to pick stocks, they just invest in a broad index, in all stocks in that index, and you can do that much more cheaply than if you actively try to pick stocks. And index funds have grown, to enormous amounts over the last decades, and are now, extremely important for households and institutions when they invest in stock markets. So that's one example. Another example is what we call modern portfolio management. So what Fama, Shiller and Hansen also showed was that there were certain factors, like this dividend to price, for example, that had some predictive ability, and modern portfolio managers now regularly use these types of factors to guide their decisions and whether they should invest more or less in stocks versus bonds and those types of things.
Can you tell us a bit about their background, the Laureates background?
Eugene Fama, who is the oldest of the three, I think his background was actually in languages, in French, I think. And then, if I remember correctly, he thought that being a French teacher doesn't seem to pay that much, so I'm going to do finance instead. And then he did a PhD at the University of Chicago, and then became a faculty member at the University of Chicago, and sort of has had a lot of impact since then. And he's been active since the 60s, but he still writes a number of important papers every year, which is kind of impressive. We have Robert Shiller. I'm not sure exactly where he got his PhD, but he's been active. He's currently at Yale University. He started doing research in sort of the intersection of macro and finance, and looked a lot at interest rates in the early 70s. And then he had this huge breakthrough with showing the predictability and excess volatility, as it's called, of stock prices. And he's been very active in the last few years, both in research but also as as a popular writer too, trying to bring these subjects out to the lay people. And Lars Hansen, I think, got his PhD at Minnesota, if I remember correctly, and worked at Carnegie Mellon University, then came to Chicago, and he's been incredibly influential in sort of, not just for asset pricing, but generally to develop econometric or empirical methods to analyze data all across economics.
Finally, how did they react when you called them?
They were very happy, and they actually seemed, I think these are names that all have been sort of in the discussion for a while, if you read blogs or newspapers, but they were still, all three of them seemed very surprised and honored to have gotten the prize. Right. And they also liked a lot having received the prize together.
And they will be here in Stockholm in December?
They will be here in Stockholm in December, and we will get the opportunity to hear more from them. And I think they're going to be very interesting discussions. They're all people who are very interested in debating these issues.
Thank you very much.
Thanks.